Reserve Bank of India has sprung a surprise by holding key rates steady against the widely held expectation of a rate hike today. But it signaled future rate hikes by changing its stance from neutral to calibrated tightening. CNBC TV 18's Banking Bureau brings you the highlights of today's policy.
After two back-to-back rate hikes, the Reserve Bank today held fire despite widespread expectations of a rate hike. The repo rate, or the rate at which RBI lends money to banks, was left unchanged at 6.5% in a 5-to-1 vote. However, the Monetary Policy Committee changed its stance to calibrated tightening from neutral, clearly signaling future rate hikes and reiterating its inflation targeting objective.
What this stance indicates very clearly is that going forward there are only two options in this particular rate cycle. Either we increase rates or we keep them steady.
Bond markets cheered, but with the global investors widely expecting emerging market central banks to defend their currencies, the status quo policy prompted the rupee to breach the 74 mark to the dollar for the first time and hit a fresh low.
Prior to this, we had two rate hikes in the space of literally 2 months. And today's stance of calibrated tightening essentially means that in this rate cycle, a rate cut is off the table, and that we are not bound to increase rates at every meeting because that is not required given our inflation outlook and forecasts at this point in time. As new data comes in, we would look into changing our policies accordingly. But the calibrated tightening is the appropriate stance at this point in time.
Besides pausing, the MPC also projected inflation at 4% in the September quarter versus 4.6% projected earlier. It also lowered the inflation forecast for the second half of the year from 4.8% to 3.9% to 4.5%, and for the first quarter of FY20 from 5% to 4.8%. GDP growth forecast for FY19 was retained at 7.4%. Despite these benign forecasts, stock markets ended at the lowest level since April. The fall was partly triggered by the lower rupee and partly because the RBI read the Riot Act to NBFC companies.
The NBFC sector overall is quite strong and the regulatory and supervisory framework is robust. So we are looking at strengthening. There is an ALM guideline for them, but we are looking at strengthening them so that we can avoid this rollover risk going forward.
The RBI also lauded the steps taken by the government with respect to IL&FS and said it will interact with the new board if necessary.
A policy that does not deliver a rate hike where one is expected normally leaves markets enthused. But that was not the case today. Only the bond markets had a muted positive response. Other markets, notably the currency, sold off seriously. There the takeaway is that the Reserve Bank was expected to have financial stability also as its mandate. The Reserve Bank saying that inflation is its sole mandate and that the rupee should be allowed to find its own level and correct trade deficit on its own was something that the markets were not prepared for, and hence the sell-off. The NBFC stocks also sold off because now the Reserve Bank says that asset liability mismatches are serious and it will write more rules. This is a shock when the markets were actually expecting some kind of a sucker, a line of credit for the NBFCs. All told, this was a policy that seriously rattled the markets. Let's see how they react on Monday. From the Reserve Bank headquarters, this is Lata Vig.